Imagine a farmer deciding when to pay their taxes. They have a choice: pay a tiny fee on a handful of seeds today, or keep those seeds for free and pay a percentage of the entire massive harvest decades from now. For a farmer, the decision is straightforward. You pay the tax on the seeds to ensure that every single grain grown in that field belongs entirely to you. Yet millions of Americans take the opposite deal with their retirement savings. They choose to protect the seeds today, only to hand over a massive portion of their final crop. Traditional 401ks and IRAs facilitate this by offering an immediate tax deduction. You keep your full contribution today, but you agree to let the government tax the total balance, principal and growth, when you retire. This strategy is often driven by a fear of opportunity cost. The logic is that by paying taxes up front, you leave less money in the account to compound, which should, in theory, lead to a smaller final balance. That logic feels intuitive, but when you look at how taxation actually compounds over 30 years, the math starts to tell a different story. To see if upfront taxes actually stifle growth, we can run a baseline mathematical scenario popularized by Ed Slott. Imagine two investors start with $100,000. Over a decade, both investments double. We'll apply a flat 30% tax rate to both. The Roth investor pays that 30% tax today. Their balance drops to $70,000, which then doubles to $140,000 of tax-free profit. The traditional investor keeps their full $100,000, which doubles to $200,000. But the 30% tax at the end removes $60,000, leaving them with exactly $140,000. When tax rates remain flat, the net result is identical. The fear that upfront taxes kill compounding is a mathematical illusion. However, tax rates rarely stay flat for 30 years, and when those rates fluctuate, the sequence of when you pay the tax changes everything. This model tracks a $10,000 investment over 20 years, growing at 6% annually. We'll assume a steady 22% tax bracket. In a traditional account, your investment grows to $32,000. Taxing that entire harvest later at 22% costs you over $7,000. Paying that same 22% tax on the seeds today costs only $2,200. You keep the entire $32,000 harvest, netting nearly $5,000 more in spendable cash. Paying the tax when the balance is small secures a higher net return simply by changing the sequence of taxation. These calculations only cover basic income tax. The risks increase when you account for the hidden taxes triggered during retirement. Financial planners use a metric called the effective marginal rate, or EMR. This measures the true tax cost of the very next dollar you withdraw. Large withdrawals from traditional accounts can trigger a chain reaction. That extra income can cause more of your Social Security benefits to be taxed or increase your Medicare premiums. This is the EMR trap. A modest withdrawal triggers a cascade of taxes, pushing your actual costs far beyond your stated tax bracket. To avoid this, wealthy investors maneuver their money into accounts that don't count as taxable income. They use backdoor and mega backdoor Roth strategies to move money into tax-free accounts, even when they exceed the standard income limits. Depending on the plan, high earners can funnel up to $72,000 of after-tax money into these accounts every year. These strategies reflect a specific priority: keeping the government's hands off the final harvest. This suggests that taxes are not just a mandatory penalty, but a strategic variable you can control. You cannot control the market, but you can control when you pay the government. This chart shows a $4,300 tax savings for a diversified investor. By utilizing a Roth, they avoid a higher tax bracket, allowing savings to last longer. Upfront taxation functions as a buyout clause, a way to permanently remove the government as a partner in your future compounding growth. Securing that buyout now offers protection against the macroeconomic reality. A nation with rising debt is likely to seek higher future tax rates. Audit your own retirement strategy. Are you protecting your seeds today, or are you risking your entire harvest?